Hello guys, what is up and welcome to episode 1 of Mastering the Market. Now this is going to be a 9-part series where I'm going to teach you from the very beginning to the very end how I trade Forex and how I have become a full-time trader doing just that. Now this is going to be your one-stop shop, so if you need to know anything about Forex, come to any of these videos and you can find it all out without having to go anywhere else. So, without further ado, let's jump straight into it. This episode is going to be the introduction to Forex trading. So, we're going to teach you the basics, the fundamentals, and all of that good stuff. So, let's get into it. Forex, short for foreign exchange, is a global currency exchange marketplace. It's the largest and most liquid financial market in the world, with trillions and trillions of dollars traded every day. Now, one unique aspect of the Forex market is that it involves trading currency pairs. So, instead of just trading a particular stock, cryptocurrency, etc., you're trading currency pairs. Now what this means is that you are backing one currency against the other, so you're speculating on the relative strength of each currency compared to the counterpart that you are trading it with. What does that mean? Well, let's take Euro USD for an example, one of my favorite pairs to trade. Now, when you're trading Euro USD, you are comparing the strength of the euro versus the strength of the dollar. So if you believe that the euro is going to strengthen against the dollar, you take a buy. And if you believe that it's going to weaken against the dollar, you'd do the opposite and you'd sell the pair. Now, before you start to learn how to trade, you have to understand the fundamentals of the market, how it moves, as well as some key terminology. So let's get straight into that. Firstly, as you can see here, we have some candlesticks coming on. Now, this might be a little bit confusing to you, and that's not a problem at all. We're going to go straight into how candlesticks work, how to read them, and all of that stuff in just a moment. But before we do that, let's understand how the market actually moves itself. So, when you have people buying and selling the market, this is going to push price depending on the size of the order. Now, obviously, people like you and me with our, small capital are not going to be pushing the market every time we place an order. However, institutions, banks, countries even, who are trying to, get a hold of certain currencies, when they place their orders in the billions and millions and trillions, they are going to move the market. So what does that mean? Well, if you see a large buy order coming in, this is going to push the price of the market upwards, because as their order gets filled, the sell price is going to be higher that they get filled at. And yeah, this is essentially how the market moves. Now, once you understand that, you can start to understand how volume works. Now, volume is our next key term. When we're thinking about volume, this is essentially how fast and how much the market is moving. Now, this completely depends on the amount of buyers and sellers in the market at any given point. Let's say that, there's some big companies, banks, countries starting to place their orders. They're opening up for the day, for their trading day, or hedge funds, etc. That's when volume is going to pick up. But during the night time when these banks are closed, volume's going to die down a little bit. Price won't be moving as much. And for that reason, we don't want to be in the trade when the volume is lower. But we will get back to that on a later date in much, much more detail. So, the first thing we need to know before you start doing anything in the market is how to read a candle. Now, this is very important. Since we're going to be using technical analysis, you need to understand how candles work and how we read price backwards in order to understand the market. Now, let's say that we have a candle like this. It's a green candle, which means it's bullish, so the price is going upwards. You might think, well, what does this candle mean? Well, it's pretty simple once you understand it. This line right here is going to be the open price. So that means essentially whatever time frame the candle is on, whether it's a 30-minute, a 5-minute, or a 15-minute candle, when that candle opened, this was where price was. It opened at that price point, and it's going to start moving from that very level. After that, we have this area here, which is going to be the close price. So at the end of the 5-minute candle or the end of the 1-hour candle, depending on what it is, the candle closed there. And that means that, once you're closing above levels and once you cement in those closures, that's when we can start to make decisions on where price is going to go. Now, this top area here is what we call a wick. So the skinny line right here that you just see is what we call a wick. Now, the top of that wick is the highest price that the candle reached throughout its time being open. So if we have a 1-hour candle, throughout the hour, price came up to this level, but has since come back down to this area right here before, we closed on that hour. And likewise, this bottom wick area right here is the lowest price and likewise, this bottom wick area just here is the lowest point which price reached during that candle. And what that means is that when this candle was open, maybe we had something like this. We opened at this level here, we started to come down a little bit, grab some liquidity, which we'll explain later, and continue to come upwards and, you know, make a top wick and retrace a little bit before closing at this area here. Pretty simple to understand. And obviously, if you did have a bearish candle, we'd be looking at something the opposite, right? We'd be looking at, let's say, let me just draw this here for you. We'd be having something like this, being the open price, this level here. This is the highest point we hit, and the close point would be obviously just down here, the inverse of a bullish candle. But yeah, hopefully that makes sense to you. Bullish meaning going up, bearish meaning going down, and pretty simple, right? Green is up, red is down. Very simple to remember. Once we understand that, we can move on to the next topic, which is going to be when volume comes into the markets and what that means. So, as a general rule of thumb, you always want to be trading when there's periods of high volume. If there's not much volume, you can be stuck in a position for a long time, and the likelihood is that it's going to be a losing position when volume does pick up. So, when does volume come into the market? Well, this is very important. Volume comes into the market on the 4 main stock exchange openings. Now, what are these? Well, if I pop this up on the chart real quick, here we have a table of all of the major exchanges which trade Forex and when they open. So if you see here, Sydney, which is the smallest one of these, is going to have the least impact. We're not going to take advantage of that at all. We're not going to look into it. But Tokyo, now all of these markets open at either 9 AM or 8 AM depending on the country they're in, but you can see what they are in Eastern Standard Time and UTC right here. But whenever these markets open, for example, for me, Tokyo opens at midnight, London at 8 AM, and New York opens at 1 PM. When these opens happen, that means the banks are opening, they begin trading at that very moment, and that means that volume is going to come into the market. The banks and institutions are going to start moving price with their large orders. So what that means is we can time our trading to be active around those points, and if we get setups around these areas, that's going to be great. It's going to be more likelihood of us being in that position and getting out as soon as possible. Additionally, on the closes, there's also going to be a lot of volume. So for example, when London closes for me at 4 PM, or, you know, Tokyo closes at 9 AM, that's going to bring volume into the markets because the banks are closing down their orders. Maybe if they don't want to hold them overnight, they sell their positions and shut down their orders. So trading around these times is going to give us a lot of potential for positions, and, you know, gives us volume, which is massively important to the game. So that's all you need to know for that one. The next key phraseology that we're going to look into is pips. Now, what is a pip? A pip is essentially how we are going to measure how much price has moved in a certain amount of time. So a pip is just a unit of measurement relating to the charts. So how do we measure pips? Well, if we are looking on TradingView, which we've got right here, the main tool that we use to trade on, we go over to this measure tool right here, and we can measure from where the candle has finished to the top of the candle. That is 9 pips. Now, you might be thinking it says 91 here, but as gold traders ourselves, we need to understand that this number right here on the right divided by 10 is the number of pips that we have moved in that candle. So if we look at yesterday's daily candle, how far did it move from the top to the bottom? So from the top wick to the bottom wick, moved 175 pips. Now, that is important for us to know because later on we are going to use pips to calculate our stop loss and our win rate and how much profit we're making per day. And that is going to be it for the first video. So I do hope that you have got a good introduction into Forex trading so far. Now, as I said, this was just the first introductory video. The next video is going to get increasingly more complex throughout the series. By the end of it, you are going to be able to become a full Forex trader, or at least begin your journey with a lot more knowledge. So if you did appreciate that video, you got some education out of it, maybe you are starting your journey to becoming a Forex trader, please feel free to drop a like and leave a comment. If you have any questions about anything we discussed or anything you want to know more about, leave it in the comments. I will be replying to every single comment down there below. I appreciate you all very much for watching. Tune into the next one to continue your journey into becoming a profitable Forex trader and making that money to escape your job. So peace out, and I'll catch you in the next one.